The US election was a key driver of markets over the December quarter. Investors welcomed the prospect of tax cuts and deregulation under a Trump presidency, with the S&P 500 up 2.4% for the quarter and 25% for the calendar year. Closer to home, the ASX 200 declined 0.8% in the quarter, in part due to a softening of the Chinese economy. However, our markets still returned a solid 11.4% for the 2024 year. In fixed income, bond yields rose and prices fell over the quarter as economic data continued to positively surprise and investors assessed implications of US tariff and immigration policies. The Fed cut rates by 25 basis points in November and December. However, they also flagged a more incremental approach in 2025 as the US economy and labour markets remained resilient. Whilst holding cash rates steady at 4.35%, the RBA softened its tone in response to weaker than expected Q3 GDP data, which slightly increased hopes of an RBA rate cut. Globally, the probability of a recession has receded, and the shift to an easing cycle has raised expectations that growth will re-accelerate. This has driven bullish investor sentiment, as well as expectations for continued solid corporate earnings growth. In the Australian market, returns have largely been driven by increasing valuation multiples rather than earnings growth. In our view, valuation increases are not a sustainable way to generate returns, so we'll need to see earnings growth come through for the Australian market to move materially higher from here. Despite optimism for global growth, risks remain. These include the potential negative impact of Trump's policies on global trade and inflation, China's ongoing economic struggles, which pose risks to global growth, and elevated equity valuations, which seem largely dependent on sustained earnings growth to drive further gains. On the positive side, as we enter 2025, several factors provide a supportive backdrop for global markets. Continued, albeit slower, rate cuts, resilient economic growth and labour markets, and stimulatory fiscal policies, all of which combine to create a favourable environment for corporate earnings growth and for equity market returns.